Hi, Jerry. Good morning.
Good morning and good evening.
Okay, good. Okay. Good morning and good evening. Okay. Yes, Jerry, you are in the States now, right?
Yes, sir. Minnesota.
Yeah. Well, yeah. Welcome to my live stream. Okay.
I got started in real estate about 12 years ago. My wife and I decided we wanted to buy single family homes in the United States where we could renovate those properties, force value appreciation, and then sell them. That was 12 years ago. However, in 2015, my wife and I decided to double down on children. We went from 2 children to 4 children, and it was becoming very difficult for us to have full-time jobs and continue to build a real estate business that was buying single-family houses. So in 2015, we decided to shut down our real estate business, which was focused on buying single family homes. And instead, we started investing money in passive real estate syndications, mainly in multifamily apartment properties, where we could still invest in properties that needed to be fully renovated and fully rehabbed, but we were not needing to do the work on those properties because there was someone else, mainly an operator or a sponsor, that was responsible with their team to renovate large apartment communities and properties. Most of these properties were built 30 to 40 years ago, and they were very classic on the inside and needed to be fully renovated. And that was now then a part of our new strategy so that I didn't have to spend time away from my family, which was growing from 2 kids to 4 kids. And my children wanted me to spend time with them, going to their gymnastics competitions and figure skating and hockey, etc. So now today we look to partner with investors that want to partner with us on future properties that we're looking to acquire and implement that value add business plan. That value add business plan, again, is mainly to buy properties that were built 40 years ago that have old interiors, so old appliances, old flooring, old countertops, old cabinet boxes, old exteriors. And we bring in our team, which is a vertically integrated property management team, vertically integrated construction team, and we're looking to fully renovate 100% of the units that are old and tired, okay? It typically takes us about 2 years to fully renovate all of the interior properties. At the end of renovations, we're able to increase the rents for the tenants or the residents that live in those units, which ultimately increases the net operating income so that we can produce a good-sized return for our investors that choose to partner with us.
Okay, maybe let me speak in Chinese is better. Okay, so 他自己现在目前 Jerry 参与的房产投资超过30栋楼，然后呢，他是这个5个公寓房的普通合伙人投资者，然后呢，他又是这种翻修啊，就是他是 GP， 然后他本身又是这个马拉松爱好者哦，I'm curious，OK， 马拉松爱好者 ，OK， 然后呢，他走遍了美国的50个州啊，他是可能看出来他是一个体育的这个叫什么爱好者啊，他是青少年这个冰球教练。OK， 下一页。
Sure, and we can move through some of these pictures if you'd like as I'm talking. So this is my family. My wife is Marlene. I have 4 children. 3 of them are boys, and I have 1 daughter. My older boys are 17 and 15 years old, and my twins, Jet and Juliana, are 11 years old, and they were my children that we were blessed to adopt from Wuhan, China. So maybe we can move on to the next slide.
Okay, great.
Yeah, so this is pictures of my family in the year 2014. So in 2014, my wife and I traveled to Wuhan, China, to adopt Jet and Juliana. My wife and I we desired to have more children, but we were not able to. And we had traveled to China when we were in college to teach English at universities. And we fell in love with the Chinese people. And so at the time that we decided to adopt, we were very interested in exploring adoption through the country of China. And so we partnered with an adoption agency located in Wuhan, an orphanage there. And after about 6 months of preparing, we traveled to Wuhan to adopt Jet and Juliana and bring them home to the United States to be with our forever family.
Okay, great. So when you adopted the twins? 2018?
2014.
Okay, 2014. Okay, great.
Okay, some additional pictures here that were taken. I believe that, well, of course, we're in Hong Kong. They're making our way back home to the United States through the airport. The picture to the right, I believe, is taken in Wuhan, and the picture on the far left was taken in Beijing as we were traveling around the city, visiting places like the Forbidden City, Tiananmen Square, the Silk Road, those types of places.
Okay. Okay. So since you adopt two Chinese children and you know a lot about Chinese cultures, so what type of impression that you have on how Chinese invest their money?
Yeah, it's a great question. I think there's a big difference between the way that the Chinese people invest and the way that most people in the United States invest. And that is what I've learned is the Chinese people place a high value on stability and security. Okay. Chinese people like to invest in things that are conservative. Okay. And they have a strong preference for investing in tangible assets, hard assets, things like real estate, things that store value. Chinese people value education, and they value generational wealth, which is very prioritized. And the Chinese people like to focus on long-term value and stability, which really closely aligns with passive real estate investing, which is why I think Chinese people generally tend to prefer investing in things like real estate as opposed to investing in stocks.
So let's move forward for the next question.
Okay. So so you kind of already mentioned this before. You start with single family, and then because of the size of the family start changing, you don't have time to do that anymore. Then you jump into multifamily. So how come you pick multifamily, like multifamily, not other commercial real estate, such as retail industries or storage? Why you pick multifamily?
It's a great question. I really like multifamily, and specifically what we call a B class asset, which is where it's workforce housing. It's where the majority of the US population lives today, is going to be in that B to B plus class multifamily. I really like that asset class because, quite frankly, everyone needs a place to live. Okay. And because of that, whether the economy is going well or the economy is going through a time of recession, that specific asset class in multifamily B class is again recession resilient. Okay. If we're going through times of recession, people that live in A class properties tend to come down to B class. And during times of economic expansion, people that live in C class will tend to go to B class. In addition, in the United States, it's becoming very difficult for young families and individuals to purchase single family homes. Very expensive in the United States. It's a lot more affordable for that young family or that individual to live in an apartment unit or property versus owning a single family home.
Okay, the next question. So do you invest in stock? Because that's the most popular way US people invest. And then how do you balance your investment portfolios?
It's a great question. And yes, I invest in stocks, and most people in the United States do invest in stocks, but I do encourage people to diversify into other types of investments. The reason why I like multifamily real estate is because it allows me to diversify my investments outside of Wall Street and into Main Street. I like multifamily real estate because it pays me consistent cash flow every single month. In Wall Street, most stocks do not pay a dividend. And in Wall Street, the investor is subject to the to where the stocks are on any given day. They can fluctuate a lot. Okay. It's very uncertain. Whereas with multifamily real estate, it's a safer investment, and it is not subject to other investors increasing or decreasing the value of that stock.
Riva, next, okay. So I would say is, I say pretend you're Chinese. So what type of criteria do you use when you try to pick a GP team or fund manager to invest your money with?
Yes, I like to consider my family to be a Chinese American family, so we are part of the family. When it comes to investing in real estate, it's all about the GP team or the sponsor. When it comes to investing in real estate, it's like taking an airplane ride. Okay, everyone is intending to go to the same location. The pilot has a responsibility, the passengers have a responsibility, the flight attendant has a responsibility, the mechanical people have responsibilities, right? So that is like a syndication, okay? But in order to safely get from my destination to my destination, I'm trusting the pilot to get me there. Okay, that's the GP team. So when choosing to invest in multifamily, you have to understand that it's not about what the projected returns are or how glossy the investor presentation looks, or even the business plan itself. It's all about the team that you are trusting with the fiduciary responsibility to produce the types of returns that you're expecting. Not all GP teams are going to have success in producing the expected returns.
Okay, next question. So with the Riva, can you go down the next slide? So with the current interest rate, we have a high interest rate environment. Why this is still a good time to purchase a multifamily?
Yeah, that's a great question. So with interest rates being higher, it generally means that there's less transaction volume, and it also means that valuation tends to go down. Okay. So when valuations tend to come down, that means that we can actually acquire properties at a better basis than they were just 2, 3, or 4 years ago. So it's a better time to buy real estate right now than it is to sell real estate in the current economic cycle. When we acquire properties, we actually acquire properties with a manufactured interest rate cap. Okay, what that means is that we're effectively buying whatever rate we feel comfortable with. Most properties we buy are at a 4.75% interest rate. Okay, we're paying additional money up front to buy that fixed rate during the course of the hold period. So that allows us to control the potential further increase in interest rates. While in the United States, interest rates have largely peaked, and now they're starting to come down. The Federal Reserve Bank, in fact, just decreased the Federal Reserve interest rate by 50 basis points just this past week.
So we were wondering, because your company only focus on certain areas. So why do you guys pick Dallas, Texas? Why do you guys like this area?
Great question. We like areas that there are a good amount of properties that fit our buy box. So we are only interested in acquiring properties that were built 30 to 40 years ago that we can renovate 100% of the interior units and increase the rents, which ultimately increases the value of that property. Because in multifamily, these properties trade at a multiple of net operating income. So if we can force the net operating income and increase it, we can create additional equity and profit for our investors. Why we like Dallas is a stable market. Okay, it's a low regulatory environment in Dallas. There's also good job growth. There's good job diversification, and there's good wage growth. So usually when you have those three factors, you have good job growth, good wage growth, and good job diversification, it usually sets up for a really good environment for a high concentration of B class to B plus class renters in that specific market.
Great.
Okay, next. Okay. So so a lot of people doesn't know about multifamily. So how does multifamily valuation is calculated? And then what are the different ways that you can increase the property's valuation?
Yeah, these are a great question. So multifamily properties are not traded the same way that single family houses are. Single family houses in the United States are based upon comparables of other single family homes in that same area. Multifamily is different. Multifamily valuation is based a lot like how businesses are valued, okay? And it's that net operating income, all right? So that net operating income divided by the purchase price or the sale price allows you to come up with what's called a capitalization rate, okay? And so if we can renovate units and increase the rents by $200 per month, spread over 200 to 300 units, if we can install washer and dryers in units that currently don't have them and get an additional $50 per unit, spread over $200 to $300, we're increasing that net operating income. And if you take that net operating income and factor it into what the local capitalization rate is in that market, which is constantly fluctuating based upon where we are in the economic cycle, then we can determine what the value creation is when it comes time to sell the asset. So for us just to do something very small, so if we put washer and dryers in all of the units that currently don't have them, let's say that's 100 units, for example, okay, for just example purposes. If we put washer and dryers in 100 units at a $50 rent increase or premium each month, that will literally create a couple of millions of dollars of additional equity that we can then pay to our investors at the end when that project goes full cycle. Another area that we create value is by bringing in our management team. So our construction team, our building maintenance team, our property management team, because we have a lot of confidence in our team's ability to properly operate and manage that property, that in and of itself will help increase occupancy. It will attract more residents to want to live in our properties. And of course, after we renovate units, now people have a much cleaner, nicer, safer unit and neighborhood to live in.
So what is the average holding period for a deal? And then what type of multifamily does your company prefer to sell? And what type of properties your company what is willing to keep for long-term as long-term rental?
It's a great question. So our strategy is not to hold these properties for a long period of time. In fact, we want to buy, renovate, and sell as fast as possible. Okay. We believe in the velocity of money. I believe that when money sits stagnant, it loses value, especially with things like inflation, right, in the US. So we prefer to buy the properties at a good price or a good basis, renovate 100% of the interior units, rebrand the asset, put in new 3-tone exterior paint, right? Stabilize the property and sell it to the next buyer as quickly as we possibly can. Typically, it takes about 2 years to fully renovate 100% of those units. At that time, we're ready to sell. However, if the market at that time is not conducive for us to sell the property, that's okay. We'll hold it for another 1 to 3 years to see what happens in the local market, and then ultimately decide to sell it to the next buyer, assuming the market conditions are good. We're not going to sell a property if it means giving the next buyer a discount, okay? We're going to wait until market conditions improve so that we can ultimately sell the property and provide a good return to our investors.
Oh, actually, I forgot to ask Jeremy one more question that's not listed on the slides. So when you sell, if you have 100%, you fully renovate the whole apartment, who are the potential buyers of this type of properties?
That's a great question. You have to begin with the end in mind, right?
Yes.
And so usually the buyers of our fully renovated properties are going to be other private equity companies that want to buy the property and put it in their either private or publicly traded REIT or real estate investment trust. Okay. We also sell to BlackRock and State Street and Vanguard. Those are very large institutional grade buyers that are not interested in buying properties that were built 40 years ago that have not been fully renovated. Okay. They want to buy properties that are already renovated. They're already turnkey. There's not a lot of loss to lease. There's not a lot of building maintenance or renovations that need to take place. But we've also sold to hedge funds. We've sold to life insurance companies. We've sold to other syndication teams that want to acquire properties and just produce, a low preferred rate of return to their investors, but they're not interested necessarily in that equity upside. It's a fairly low equity upside at the end if you're buying a turnkey property because you've already forced the value, at that point, out of the asset.
Great.
Okay, go ahead, Kathleen.
Okay, next question. Oh, by the way, Jeremy, we have about close to 900 people are listening right now. So a lot of people are interested.
So, Jerry, you did great.
Great. Let's get it to 9,000 next time.
Okay.
Okay, great.
Okay. So the next question, Riva. Okay. So what's the biggest risk in investing in multifamily? And how does your company handle or prevent this type of risks?
Yeah, absolutely. So there's risk in all types of investing, including investing in multifamily real estate. We really aim to protect our investors' capital because without investors' capital, we're not able to acquire multifamily properties. So it's all about our reputation. It's all about our brand. It's all about the fiduciary responsibility we have to protect our investors' hard-earned money. Okay, so that is priority number one for our team. So how do we do that, right? There are risks prevalent in multifamily real estate investing. I tell investors all the time that birds fly, fish swim, and real estate has a tendency to fall apart, okay? It's just what happens in the business, and that's why it's all about the sponsor and the team that's managing the property and the execution of that value add business plan. It's all about them, okay? So there are things like, for example, there's fires that burn apartment units down or entire buildings down. There are hurricanes that, visit the United States, this time of year every year. What are ways that we help mitigate against some of those uncertainties? Obviously, by purchasing the right types of insurance, right, on the front end, so that in the event of a catastrophic challenge at the property level, we have insurance that's able to cover that to help protect our investors against something like that unfortunately happening. The other thing is interest rates, right? Nobody thought that interest rates were going to skyrocket in 2021, but they did, okay? And a lot of operators or sponsors were stuck, okay? They weren't able to afford their debt service payments because their interest rates skyrocketed. Well, our team purchases a rate cap to protect our investors from the unlikely or likely case that interest rates continue to fluctuate over time. So we're really manufacturing an environment where we can ultimately protect our investors and their dollars.
Okay, great.
So the next question was, Jeremy had wrote books about passive investing. So I don't want you to tell us everything about your books, but what the highlights are, and then what is your next book going to come out? Like, give us a little bit background on that.
Yeah, great question. My next book is called The Fundamental Investor. You can read up more about it at fundamentalinvestor.com. The book is not published yet. The projected published date is December the 3rd. Again, December 3rd for The Fundamental Investor. The book is really about my journey, okay, from a mindset perspective, how I thought about investing, how the education system taught us about investing, how my parents taught me about investing, and then the eventual mindset shift into why am I gambling in Wall Street when I could invest in Main Street businesses, mainly multifamily, that produce consistent cash flow, they're risk adjusted, they're a hedge against inflation, there's tax benefits associated, at least with US investors, investing in these types of properties. So the goal was really a way for me to learn about and to communicate to others the benefits and the power of diversifying your investments outside of just Wall Street, which is, can fluctuate up and down every given day, to something that's more stable and consistent, like multifamily real estate.
How can you control the cost of the renovation? Let's say if the cost become, very high than the anticipation, then the project will lose a lot of money. So how can we, solve this problem?
Yes, I think I understand the question. So we actually, before we take the deal under contract, we have a team that walks 100% of the units through our due diligence process. And because we've renovated literally thousands of units, okay, across markets like Phoenix and Dallas and Charlotte, we know what those costs are up front. And we actually purchased the materials from an overseas supplier in Taiwan that has a local warehouse in the market that we're acquiring the target property. So we know what those costs of the renovations are up front because we've done it before, on time and on budget.
Okay, go ahead.
Oh,
So
next question.
Jerry, we have more than 1,000, attending. Okay, I'm in the audience now.
It's great.
Okay.
9,000.
So you mentioned that you have ADHD. It's a disease, people probably doesn't know what ADHD is. I will let you explain that. So how does that influence your approach in investing and managing your businesses?
Yeah, it's a great question. So for those that aren't familiar with ADHD, it's really not necessarily a disease. It's just something that some people are born with, right? It makes it challenging sometimes for people to focus on one thing at a time. Okay. So if I'm in a room surrounded with other people, I'm going to have a difficult time focusing on a conversation with one person when there's all kinds of other things happening in the same room at the same time. Okay. So it makes it very difficult for children to go to public schools, right? Where the teacher is talking, but their friends behind them are also having conversations. So somebody with ADHD is going to have a hard time focusing on what they should be focusing on, and that's the teacher, when they're too busy thinking about the conversation that their friends are having behind them. Okay. So I actually consider ADHD to be a superpower for me. Okay. Because it allows me to be able to focus on more than one thing at the same time. Okay. In real estate, that's very important because there's constantly things that are influencing the management of that property, both in a good and also in a bad way. When it comes to investing, okay, it's allowed me to not just focus on what my financial advisor is telling me to do, but rather to explore, okay, other aspects of investing, mainly in alternative assets, like, for example, real estate. In the United States, everyone is told they need to invest in stocks and bonds and mutual funds. Very rarely are children and even young adults and adults educated on the power of passively investing in multifamily real estate. It's just not taught in the public school system. It's not taught at our universities, and it's not being taught by our financial advisor community either.
Oh, I think I think you already answered this, but I'm just gonna say this again. So what led you to make a significant mindset shift that moved you from traditional investing to real estate syndication?
Yeah, it was really just being desensitized with Wall Street. I think Wall Street is like a gambling casino. Okay. Sometimes stocks will go up on bad news and stocks will go down on good news. I never understood how that's possible. I know that there's a large day trader community out there that influences, that influences stock prices. I know there's institutional grade investors out there that have a massive amount of influence over whether stocks go up or whether stocks go down. So I just came to a point in my investing journey where I said I wanted to invest in something that's not so uncertain. Okay. I wanted certainty with my investing strategy. And that's really why I turned to investing in real estate syndications, is because I wanted to invest in something that was consistent, where I knew that there was an actual business plan, where I could get on the phone or send a text or an email to the main team that's actually managing the business plan itself. I can't get on the phone right now and call Elon Musk and say, hey, Elon, what's your next plans for SpaceX or Tesla? I would never be able to do that. But I can get on the phone with a real estate general partner and have a direct conversation with them to talk about how the business plan is going, right? You can't do that when you invest in Wall Street, but you can do that when you invest in Main Street.
So can you share your story for your first syndication deals or the first couple syndication deals? What happens, how it goes, what type of return that you got?
Yeah, I'd be happy to do so. So we made our first investment in a real estate syndication in 2015. And to be honest, I used what I call the shotgun approach. I held my breath, I plugged my nose, I didn't know what to expect. Okay. I knew a very little amount of information about real estate syndication investing. But what I did know is I, number one, wanted to continue to invest in real estate. But number two, I didn't want to be the person that was having to be involved with managing residents. I didn't want to swing hammers on the weekends anymore. I didn't want to evict tenants. Okay. I didn't want to have to deal with termites and trash and clogged toilets, things like that. So I wanted to stay invested in real estate, but I didn't want to actively manage those properties. Okay. So in 2015, I invested in our first real estate syndication, again, having a little bit of knowledge because I knew that I was going to learn through the process. Okay. So I knew enough information to know that I wanted to invest passively in real estate, but I also knew that I was going to learn through that process of having gotten started the first time. After 4 years, that investment went full cycle and I doubled the investment and didn't have to pay taxes on the gains because of the power of depreciation benefits in the US.
Okay, next question. So how important is due diligence when you selecting, a general partner, and then a sponsor for your next multifamily investments?
Yes, this is the most important question of all of them.
Okay.
And that is vetting the sponsor. As I mentioned before, it's not about what the return projection looks like. It's not about the glossy pitch deck. It's not even about the business plan. It's about that sponsor's ability to execute the value add business plan. There are some syndication teams that are 2 men in a truck. There are some that have a staff of 10. There's some that have a staff of 200. Okay. There's some that just got started investing actively in multifamily, and there's some that have been doing it for a number of years. So you need to find a sponsor that has a track record of having executed the business plan and has done it multiple times. So you need to find a sponsor that has that is willing to communicate to you transparently what they projected those investor returns to be versus what they were actually. Okay. Very important that you find out what that track record of executing the business plan, has looked like in the past. I would also argue that it's incredibly important to have a sponsor or a syndication team that is vertically integrated on the property management and the building construction side. Why? Because those are two variables of things that can go wrong. Okay. If a syndication team has a third-party property manager or third-party building construction company, what happens if that company is not performing? The sponsor is going to fire them and replace them with someone else. That causes a massive disruption, okay, in the business plan. So much better if you can control the construction side and you can control the property management side by having those components in-house. That way, the syndication team can control the entire timeline from acquisition all the way through the exit, which is called disposition.
Next question.
Yeah, Jerry, we're almost done. Okay. Yeah, we have 100. Almost 1,200. Okay.
So what do you think most people get wrong about passive real estate investment? They are afraid of, or they don't understand.
Yeah, it's a great question. Most people unfortunately invest using emotion and not logic and fact. So unfortunately, most people, when it comes to passive real estate investing, they're chasing after the deal that has the highest projected return. That is not the way to go about investing passively in real estate. Why? Because if you don't know where the sponsor came up with those projected returns in the underwriting or in the pro forma, then how can you have confidence that they're going to be able to deliver on those returns? The truth is that we have no idea what the economic landscape is going to look like in the United States in 2 to 5 years from now. There are plenty of black swan events that occur. The COVID crisis, for example, the historic rise in interest rates that we experienced just a few years ago, the global financial crisis back in 2007 and 2008, right? There are so many different external factors out there right now that can drastically change the projected returns to the investors. So I think what most passive investors get wrong is they just go straight to what those projected returns are without actually doing their due diligence to uncover how is it that the sponsor is going to protect my investment. What were the criteria or ways that they stress tested the financials? What was the sensitivity analyses that they performed? You know, once the units are fully renovated, can people that live in that market actually afford the increased cost of those rents, right? That's a very simple question to ask yourself. And so I think for the passive real estate investor, it's all about education. It's educating yourself on the benefits of passive real estate investing and doing your own due diligence before you choose to invest your hard-earned money.
Okay, so you did house flippings, like repair flippings before. So how does that experiences help you investing in syndications?
Yeah, it gave me the ability to learn about the process. So I went from actively managing, fixing and flipping single family houses to now doing the same thing, okay, but in multifamily, where we're talking about 200 to 400 units per property. And effectively, we're doing the same thing. We're just doing it over the course of 200 to 400 units. So investing as an active investor in single family fix and flips allowed me to really learn and understand the business. And that's really what I would encourage, you know, your listening audience to do. They may not be in a position to do what I did, but you can certainly learn about it, whether that's through my upcoming book, The Fundamental Investor, or that's reading other people's books, listening to podcasts, obviously tuning in to Eric and Caitlin and the wisdom that they provide as well. So really, it's all about getting educated on the types of strategies so that you're confident and comfortable when it comes time for you to make that first investment.
Okay, Jerry, we're almost done. I think we have 2 questions left.
One more. We have one
Oh,
more.
one more. Okay.
So Jeremy, you started the Starting Point Capital. And what's your envision of the future? And then also for the real estate syndication business?
Yes, great question. So I started my company, Starting Point Capital, with the plan to just educate, because I knew that there was a big void in people's understanding about passive investing in real estate or just investing in alternative assets in general. So I started the business just purely as an education platform to educate those that are in my personal and professional network. What ended up happening is that so many people became so interested in wanting to learn more and wanting to get involved investing that we were able to use our community of investors to come together to have a leverage with the sponsor. When I say leverage, the leverage of a community of investors that are all individually doing their own due diligence on the opportunity. And also, when we come together with a large investment, we're able to get a better rate of return or a better profit split from the sponsor because we're coming into that deal or opportunity as a collective group of investors. as far as what I see for the future of real estate syndication, I actually think that we're just now getting started. I think a lot of people are starting to wake up and learn more about alternative investments. And so I really do think that, as time goes on, we're going to continue to create more awareness. More people are going to become aware of the fact that they can actually make a good stream of income through cash flow and equity buildup by way of syndication investing versus just investing through Wall Street.
Jeremy, we're done. The last sentence I was just trying to promote your books. I told them that if a lot of people interested, you're willing to translate your book to Chinese. Sorry, without asking your permission first.
That's okay. Entirely okay. Thank you.
Yeah, Jerry. So what else you want to mention here?
No, I just appreciate the time and the opportunity. I really enjoy educating people about the power of passive real estate investing. If you'd like to learn more and connect with me, I am fairly active on LinkedIn. You can go to my website, which is startingpointcapital.com. You can also reach out to me through email, which is Jeremy. It's Jeremy, again, Jeremy, at startingpointcapital.com.
Okay, great.
One more thing,
Let me
Jeremy, before you leave. I'm curious, okay, personal question, but you don't need to be very specific. So when you started real estate investing, what's your net worth? And right now you said 7.5 million. So I want to know, when you started, what's your net worth?
Yeah, when I first got started, I was crushing my day job, right? I was a salesperson, so earning a lot of bonuses and commissions. So I set it up so that my family could live on my salary, and we would take our commission checks and our bonuses, and we would use those to buy houses. Okay. So I was grinding out a day job as a technology sales guy and wanted to, diversify into real estate. After I had done that for a number of years, I was actually able to leave my day job entirely because I had enough cash flow coming in from my investments where I no longer needed to work a day job.
Okay, so Jerry, sorry, we are in a hurry. Okay, thank you,
Thank you.
Bye-bye.
Yeah, 谢谢啊.
Thank you,
Bye-bye.
Jeremy.
Bye-bye.
Bye.